The BRRRR strategy, not to be confused with Jerome Powell's version of BRRRR, but this strategy is a very common tool used in real estate investing, and I'm going to try to explain it in simple terms. If you're new to the channel, my name is Jack Duffley. I'm a real estate attorney and investor, and I'd very much appreciate it if you took a look around the channel, and if you like what you see, be sure to subscribe. Now, the BRRRR strategy, this is an acronym that stands for buy, rehab, rent, refinance, repeat, and we'll go over those steps in a little greater detail so it makes sense. But the first step is quite simple. Buy. You buy the property. So we'll go ahead and draw, we'll say a house here, and I don't know, we'll say you bought it for 200 grand. It's a pretty cheap home, all things considered, given the current state of the US real estate market, but there are plenty of markets where you can buy a home or a condo or something for 200 grand. And we'll say that this property is in a neighborhood that would normally fetch something like $300,000. And because the property is vacant and needs some work, you probably had some trouble actually getting the best financing terms for it. So maybe you used something like a hard money loan, or you went to a private investor who then gave you money at maybe a higher interest rate than you might see on your more traditional long-term financing. And maybe you brought your own cash to the table to buy this property outright and you're gonna refinance it later. We're getting ahead of ourselves, but you bought this property and we'll say you actually used a hard money lender. So pretty high interest, pretty high fees, but they're willing to cover the whole purchase price and all the rehab. You got a private lender or some hard money lender who's willing to do that. So we'll say that they're able to cover the whole $250,000. So that's the $200,000 purchase price plus the $50,000 in rehab. That's very highly leveraged, but hey, we'll say you got a pretty favorable lender who's willing to take that kind of risk on you. Anyways, that means that this whole thing is financed. So we'll say this is $250K hard money, and you use that to buy the property. So that's how you buy the property, and that's how you fund the rehab, which is the next step, the first R in BRRRR. That is to rehab the property. So you have your $200,000 that you used to buy the property, you have $50,000 left over. So now we're gonna say you add the $50,000 in rehab, so 50K rehab. We'll add a little plus mark here. So you got the $200,000 property, you do the $50,000 in rehab using the money you got from your loan. So now you are going through fixing the property. You're maybe doing cosmetic upgrades, maybe fixing any systems that were lacking or that were broken or whatever. You're putting money in this property, making it better, bringing it up to market standards, or maybe even a little bit better than market. Obviously not going overboard because we're trying to keep costs down because we're making this an investment, or at least we're trying to get our money out at the end of this. One of the overarching goals here is to make this thing rentable. You want to be able to get top rent for this unit within reasonable costs. So now you're all in with $250,000 of another person's money. So great, the rehab is done. The property is all fixed up, ready to go. Now it's on to the second R in BRRRR, and that is to rent it out. So now adding to this equation here, we're gonna add a renter. So we'll add a tenant here. So now the thing is rented out. This whole house is all fixed up, it's ready to go, and you got a tenant in there. Now the tenant is paying rent, and you're able to start bringing in some actual income onto this property, maybe throwing some money towards that hard money loan, depending on the terms, but you're probably not able to really pay that thing down because it's gonna be high interest, and you really wanna get rid of this loan because that's the ultimate goal of this strategy. You got the property, it's all fixed, the tenant's there, so you think it'd be good, but remember, you have this very expensive financing over here, maybe all your cash is tied up in this deal. Whatever way you finance this property, it's now time to get to the third R in BRRRR, and that is to refinance, or refinance as business majors might say. And what I mean by refinance is you're gonna go to another lender, probably a bank, to try and get a more favorable loan on this property. But keep in mind, you already have this loan right here to worry about. They might have a mortgage on this property already, so you gotta keep this amount in mind. So now how do we figure out how we're actually gonna go through with valuing this new property? Because that's what the bank's gonna wanna do if you're going to a bank to get it refinanced. They wanna know how much this thing is worth now that it's all fixed up and how much they could reasonably lend on it. So if we continue our equation here, we have this property with a tenant in it, it's being rented out, it's all rehabbed, it's ready to go. And we'll say now it is worth that $300,000 like the rest of the neighborhood, like we were saying earlier. So here's the end of the equation. We now have a $300,000 property as opposed to this $200,000 one, since you've added so much value to it. You did a great job on the rehab, or your contractors did, unless you're doing all this yourself, in which case this rehab budget might be a lot less, but you get the point. So the lender tells you this property is worth $300,000, and they're willing to lend 80% of this property value. And lenders might differ a little bit, but we'll just use 80% as the total amount of the property they're willing to lend on. So 80% of $300,000 is $240,000. And with that new mortgage, you're able to extract $240,000 in cash out of the property via a new mortgage loan. And interestingly enough, this is tax-free because the government doesn't tax debt. yet, but they don't here because you're taking the money out as a loan. So you still have to pay this back over the long term, but now you're at more favorable terms. And the rent on this property, so long as you got a good deal, should be covering that mortgage and all the expenses on the property, so you can continue to pay it down over time without having to bring new money to the actual deal. But now what are we gonna do with this cash pile here from this refinance? You have $240,000 sitting there. Well, it's gonna go towards paying down this hard money loan. Now we're $10,000 short, so you're gonna use this, and then we'll say plus $10,000 to actually pay down this hard money loan. That is now gone. You have now paid for the entire rehab and purchase of this property thanks to this refinance and the additional, we'll say $10,000 you had to bring to the table. So it's not a perfect BRRRR that would cover all of the expenses and then some, but you can kind of see the power of this concept. Now you're into this property for only $10,000. If it's a good deal, the rent should be offsetting all the expenses. So you got a very, very low cost basis effectively on this property because you're able to successfully use the power of leverage. So just to reiterate that, you're into this $300,000 fixed up property with a tenant in it that's offsetting your expenses. You got long-term financing at more favorable rates than you could have possibly gotten at the beginning when the thing was vacant and dilapidated. And you're only into this deal for $10,000, a $300,000 property with a $10,000 basis, which means, at least relative to the size of this deal, you barely had to tie up any cash, which means you can get to the last R of BRRRR, repeat. You can repeat the process because your money is kept mobile. It's not tied up in deals. If you're using your own cash to buy the deal, you're able to get it out at the end of this, so long as all of these steps go well and you don't run into problems during the deal. Of course, there's plenty of risks with this sort of strategy. It's by no means an easy strategy. You have a lot of moving parts here, and it's not gonna work for every deal, but when it does work, boy, it can be very powerful. If you found this explanation helpful or interesting, then definitely leave a like since that would help the channel out a lot, and be sure to subscribe since I put out new videos every single week. But until next time, take care.